All right, so let's begin on expected lines. RBI did not change interest rate in its full bi-monthly monetary policy. RBI Governor Shaktikanta led Monetary Policy Committee maintained status quo on rates and stance. The MPC decided unanimously to keep the policy repo rate unchanged at 6.5%. The STF rate remains at 6.25%. The marginal standing facility rate and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. Let's discuss more on this. What does this mean for your investment portfolio, be it equity or your debt investment? And also, what about your loan EMI? Because that's not coming down. No relief on that front. Let's discuss more on this. I have with me Devang Shah, co-head of Fixed Income Access Mutual Fund, Satyam Kumar, CEO and co-founder LoanTap. Good evening and welcome to the show. Devang, I really want to understand the policy today and what does it mean, keeping the festive season in mind and also talking about the international triggers in terms of bond yields and the inflation, because everything in the policy remains the same, it's unchanged. Are we looking at inflation fear? Are we looking at bond yields peaking out already? Or what signal do you think is coming specifically for the fixed income space?
Thanks. As you rightly pointed out, I think most of the headline policy rates continued to remain exactly same as it was before. So RBI has continued with its status quo stance on monetary policy rates, be it repo. They have not tinkered along with anything on liquidity side. The CRR, ICRR, which was supposed to be rolled out and phased away, they've actually gone, it's completely phased out now. And that 100%, 10% increase, which had happened, has completely phased out now. So from an overall monetary policy perspective, when you also look across the macro data which RBI has released, be it growth, be it inflation, everything has remained status quo. They have not changed the projection for growth. They continue with 6.5. For inflation projections also, as mentioned before, they continue with 5.4% for the year. The only surprise which came across and which was not well taken by the markets, because it actually came as a shocker to the market, was more on the announcements of OMO sales by RBI, which RBI can look as and when necessary to absorb the excess liquidity. I think if I read the monetary policy or probably dwell more into it, it is more about the concerns which is on account of the way the liquidity is happening globally. If you look across at the bond yields globally, the strength of the dollar, which can have an impact on the currency. And at this point of time, when financial conditions are very, very tight globally, I think probably RBI doesn't want to signal too loose or too easy a monetary policy in India and continuously drive towards keeping the liquidity tight. Because of the phase out of ICRR of 10%, I think probable, and I think Dr. Governor Das mentioned about it also, that the 2,000 rupee note had led to the significant increase in liquidity. The core liquidity or durable liquidity is upwards of 2.5 lakh crores. And to ensure that it doesn't lead to any significant inflationary pressures on the economy, I think RBI wants to keep the liquidity tight. But the announcement of the tool specifically that can come up with OMO sales, which can add to duration to the banking system, I think was not taken well by the capital markets and which led to the yield spiking by around 10 to 15 basis across the curve. The short end of the curve has very well behaved. They have continued up to 1 to 2 year assets have continued to remain where they were yesterday. But beyond 2 years, and that I think because of the thought process of OMO sales, which can lead to some duration addition to the system, I think we have seen some curve steepness and probably a sell-off of around 10 to 15 basis today.
So in this scenario, Devang, where do you see the 10-year bond yields in India peaking out, or you think the price factors are already factored in? What's the range that you are looking at?
So if you ask me, I think, yes, I spoke about the shock which came into the monetary policy and probably not well perceived by the capital market participants. But if you look at the positive signs, somewhere down the line, couple of things, as you rightly pointed out, inflation is now peaking out. And Dr. Governor Das did mention about it, that core inflation, there's a silver lining along there, which is started seeing significant downside. So on an inflation side, I think probably the fears which all of us had on account of bad monsoons, probably oil significantly going above $90 again, I think that has started to fade away. Medium-term outlook, be it global inflation as well as India, I think it is on the lower side. Secondly, the inclusion of India bonds in sovereign indices, other global indices like JP Morgan, probably there are news floating around of we might have an addition to Bloomberg also. So all these things will keep flows and the external sector well behaved in India. I think somewhere down the line, we will start getting good amount of flows starting next year, and probably we don't anticipate any significant external shock. So if I look across at both the worries, which generally leads to tinkering of rates from RBI, which is CPI as well as central sector, we believe that they will behave very, very well. So our view on medium-term outlook or rates is probably we are peaking out. Currently, because of this OMO says, and it was, as I told you, it was not anticipated. I think in the near term, the bond markets can continue to remain a bit nervous. I would say the range in the near short term, probably for 10-year GSEC will be 7.25 levels. And on a medium term, once we start seeing these flows coming back, and next year, probably 24, once we believe that Fed starts to pause and not hike incrementally, we believe rates will start going lower and trend towards the 7% mark.
All right, Satyam, now it's your turn to plan the loan EMI for our viewers. Okay, there is no relief over here as yet, and we have seen the durations have peaked out. Talking specifically about home loan over here, the duration, the loan tenure durations have been peaked out. Now the only option left is to increase your EMI amount, which a lot of them are already done, but then it's still pinching. Looking at the policy today, where there are no changes, no relief on the EMI, and the interest rate going down, what should be the strategy now? How can you maybe rework on the EMI pressure that you have on your pocket, and which also lands up becoming a very big liability on your finances as well?
Yeah. Thank you, Kavita. So, as we see, most of the stances are very similar to the last MPC. And in the committee review itself, it comes out about the slowing consumption, the fear of slowing consumption, and slowing growth has also been highlighted in terms of every quarter's reducing GDP forecast. So from 6.5% down to 6% and 5.7% as we exit the current financial year. So there is a huge pressure on the economy, and both with a erratic monsoon as well as general inflationary trend which we have seen so far, and also we are looking forward to a further increase in the crude rates, which we are all witnessing currently. So looking at it, all the risk that is built into the system, and at the same time, there is another angle to it, is that you have a excess liquidity in the banks because of this 2,000 rupees note getting deposited. So each of the banks, if you share savings account side or a current account side of the CASA balance sheet has increased year on year, mostly by almost 30% or more than that. So that's a significant liquidity parked in the banks. At the same time, RBI doesn't want it to be parked under SDF or this thing. They wanted it to be used in intercorporate. And also what we all should expect, that the loan rates will not come down on the loans that you have taken. But as you are getting into a festive season and the weaker demand even for the normal lending rates, a lot of opportunity will come where all the banks will come back to you and will give attractive rate to the new loan seekers. And while the earlier loan does not get rechanged, that means a balance transfer opportunity will come to. What has happened in last 8 to 9 months after 250 bips of increase in the repo rate is that many of the loan accounts has gone into a negative mode, and we have also witnessed in the industry there's a significant 20% of the loan in the last 4 or 5 years which has been taken in 25-year kind of a duration. So which has a very little or insignificant amount of payment towards the principal. That means the EMI payment was not significant to keep on reducing the principal, and the EMI is going up by another 250 bips. That essentially means that you are only paying the interest and you are hardly paying the principal. In that situation, the banks were asking you to make a prepayment or plan for a repayment and all. The new situation will come where the new loan, if you are transferring the loan from one institution to another institution, then the new loan rates will be lower because the banks has an excess liquidity and they would want to deploy it in the market, which is at a higher rate than the interbank facilities. So you will have an opportunity to change from one institution to another institution, reduce EMI burden, reduce or keep the EMI at the same level, and have a shorter duration of the payment as against the preset duration of the payment. So that's one significant opportunity will come. That's the only silver lining that we can see in this the current dispensation. Otherwise, most of the stuffs are status quo, and that will keep on pressure on if you're a passive loan seeker, then nothing is changing for you. But if you're an active, then you can use this facility. The second thing which has come in is that there is a significant penetration of urban cooperative banks in the trader or a businessman segment, and as they are looking forward to stock up in the run up to the business cycle or consumption cycle of the festivities, all the urban cooperative banks limit has been increased for doing a gold loan under bullet payment scheme from 2 lakh to 4 lakh. So it's like almost double on every relationship. So if you're a businessman banking with a urban cooperative bank or in that vicinity, then all of a sudden you will be able to borrow more from the same institution with keeping a prepayment, a monthly payment without a monthly payment mode. That essentially means that you'll have more money available for you to do business or stock up material to sell in the festive seasons. So these are the two stuff that I can see in the current monetary policy, which aids one individual consumer and the second as a businessman. Otherwise, we are seeing mostly the existing relationship will remain under pressure of higher burden of the installments. The consumers will remain under pressure of the twin burden of the inflation as well as higher EMI. And not significant changes from a consumer point of view. On a side note, we see a continued focus of the regulator on creating more and more or better regulatory guidelines, and they have formally put it to MPC that they will be coming up with a guideline for creating an SRO, which is a self-regulatory organization for the industry, for regulated entities. And we are expecting there, particularly from a fintech point of view, we are expecting a fintech SRO to come before in next 6 to 9 month time, which will be again good for the consumer because there will be a better and better regulations amongst the fintech players or amongst the NBFCs or other payment players, SROs and all will also have an SRO over there, which will be more consumer friendly. So a couple of initiatives there from consumer friendly.
All right. So the EMI amount is not going down and the expenses are also not going down. So Devang, now where can we have some money made? What kind of strategy in fixed income would you want to recommend, and what kind of a duration can one look at? Should you park in just for a year, or maybe it's also time that you can look at longer term duration instruments where there could be volatility, but if you are stay put till the end of the duration, you'll be good.
So rightly pointed out, Kavita, I think probably if you look across, our view is now that at these levels, at entry levels of around 740, and as I told you, a large part of macro data now trends towards low, probably the peak of growth. We are not anticipating significant positive growth trends from here. We believe that this would be the best of the growth cycle. I think, as I told you, from an RBI perspective, when you look across at CPI as well as an overall expectation of external sector, I think CPI trends lower, external sector looks stable. So I think, yes, except a bit of volatility in the near term, rates are good to hold, and probably investors can start looking at adding. So I would say structural fixed income investors can start looking at adding short to medium term funds in their portfolio, which are generally having 2 to 4 year duration. And an investor who is more tactical in nature and probably want to benefit out of the rate cut cycles. I think rate cuts, yes, looks a bit delayed. Our anticipation is with the way things are going globally, probably the tightness of financial conditions, as I explained before, the probability of an accident actually increases. And hence our thought is at this point of time, investors are looking at more probably tactical opportunities to start investing in gilt or long duration funds, which are having 5 to 7 year duration. So structural investors, short to medium term funds, and tactical investors who are looking for in the next year rate cut opportunities and some capital gains to be made, I think should look at gilt funds.
All right, I have a lot of things more to discuss, but unfortunately the time is up for this particular segment where we tried as much as we could to help our viewers as to how can they cut down their financial liabilities and also have a debt strategy. So thank you so much, Satyam and Devang, for being on the show and helping our viewers with this today.
Thank you.